Miner AngloGold Ashanti spoke to CNBC Africa's Tumisho Grater. She sat down with the CEO of the firm, Venkat, or otherwise known as Srinivasan Venkatakrishnan, to explore the company's fourth quarter and full year results. Let's take a look at that discussion.
It's not just the assets that are not performing well. Those assets that are not performing well, which have got good potential, we'd like to restructure them and return them to profit and get them up the value curve. Obuasi is one example. But where certain assets have come to their end of useful life, don't have exploration potential, we may view them differently. Potentially what we are saying is there might be a case for one or two of our existing assets where you look at which have got very good potential, but a joint venture opportunity might make sense. And they happen to be assets that are likely to be sought after by other companies and non-conventional investors. Because certainly there is a contrary view out there, despite what is happening to the gold price, that the US recovery is fragile. There's still uncertainty around the world. And at the end of the day, what happened at the end of 2008 could happen again. So there's potential there where you could see a rally in the gold price.
If I'm looking at AngloGold Ashanti, in the next 5 years, what is this company likely to look like? What are you going to be offering me as an investor?
Absolutely the right question to ask. We offer one of the best diversified portfolios in the gold industry with long life assets. If you look around, number of gold companies are scratching end of life assets. We do not have that issue. So the first thing in the investment case, you're getting long life diversified portfolio, which gives you gold price leverage on 4 million ounces. It gives you leverage to the rand, the real, the Aussie dollar, and the Argentinian peso, to name a few, and also to fuel. That's step one. Step two, there are so many value levers that can be unlocked between now and the 5-year horizon you mentioned. Addition to that, step three is we have actually gone further than most in terms of our cost optimizations and reductions. So we are best positioned when that gold price, which is pulled back now, let goes, you start to see the margin growth come through in a big way.
You've been talking about cost cutting. That has been an important thing that you've been focusing on. But you also said in your SENS report that the real focus now is on improving margins. Now, with this depressed gold price and everything else that's happening in the mining industry, how do you intend on growing margins?
Okay, firstly, when you talk about focus on cost cutting, absolutely right, but that's not the only focus. If you look at the results we announced for 2014, we announced our best ever safety record in the business since the formation of the company. We have also grown production by 8% as compared to the previous year and 12% as compared to the year before. And that's by bringing on stream two new low-cost projects, which is Kibali and Tropicana. They have come in. In addition to that, what we have also done is removed marginal ounces from our production mix and addressed all of the cost issues within the business, whether it's direct cost, indirect cost, overheads, or what I would call speculative exploration. And we have done that without actually throwing out the long-term optionality in the business. And what is the net impact of all of that is converting a cash burn of close to $1 billion to a positive cash generation. So how do we continue to grow margins? It's focusing on those assets which have got good long-term potential and potentially implementing turnaround plans in respect of those specific assets which drag the performance of the portfolio down. The classic example is what we are doing at Obuasi, and then returning them back to profit and putting it back into the mix. At the same time, the one you have to watch out for is you start to relax in terms of the cost, and that won't happen in the company. We'll continue to keep the pressure on cost and efficiencies. And of course, the added advantage with the gold price coming down tends to be that the currencies weaken and oil tends to weaken as well. And we have very good leverage in respect of both, because for every 1% movement in the currency, we get about $6 in terms of our cash cost. A $10 movement in the price of fuel helps us to the tune of $7 per ounce in terms of our cash cost. So all of these factors are there, but importantly, continued focus, improving margins.
You say you won't relax with the cost initiatives. How much more are you going to want to start or keep on streamlining? You can only do it up to a certain extent. So what are your targets there?
I think it's a very good point. It's the saturation point. If you look at where we have come from in the last 2 years, there's been remarkable progress in terms of reduction. During this period, we've been fighting inflation, and that's inflation across 10 jurisdictions. Obviously, you tend to improve your performance as you go along. And I'm ignoring the currency weakness here for a second, but primarily looking at what guidance we have given out in terms of our all-in sustaining cost for next year. We have tightened it even further to between $1,000 to $1,050 an ounce. So there's still potential, but at some stage you start to get to the point of law of diminishing marginal returns. But that's why you want to streamline the portfolio by bringing on stream more profitable ounces back into production at lower cost.
One of the other things you're focusing on is reducing your debt. So you say you want to get it to about $1 billion US dollars. How are you planning on doing this?
We were looking at our net debt is about $3.1 billion. We said our aspirational target is to reduce it by $1 billion in the medium term. Just to contextualize it, we do not have any debt maturities of substance that mature until 2020. The first US dollar bond matures in 2020. So we don't have a refinancing risk that is looking at us in our eyes. That's step number one. Second factor you've got to bear in mind is that we have got enough headroom under our undrawn facilities. Our US dollar facility is about $1 billion undrawn. We have only drawn about 100 out of that facility, and we've got headroom under our Australian dollar facility and also in South Africa. So it's not that we're going to run out of cash. So there's no liquidity issues either.
If we look at the South African operations, Sibanye Gold came out with their results last week, and they were talking about how they've become more self-sufficient with the issue of Eskom and electricity. You are part of the intensive users energy group. What are the conversations there that are taking place? What's Eskom saying to you, and what are you saying to Eskom?
What we have done with regard to the electricity is, remember what happened in 2008 when there was a problem with the grid and the calls came into the mining companies, and the mining companies were forced to evacuate everybody and shut the operations down for a period. That has not happened since that date. The dialogue between Eskom and the intensive energy users group is taking place regularly. We get enough advance notice in terms of where the pressure on the grid is, good communication, and over this period what we have also done is pull down our electricity consumption. If you look at our consumption pattern in the last 2-3 years, we have pulled down somewhere between 10 to 20% a year in terms of making our operations more energy efficient. And at the same time, we work closely with Eskom to manage our power requirements better, to reschedule the time when we operate the plants and the mills, and also cut out non-essential areas during peak demands.